Joining me now, Art Hogan, Chief Market Strategist at B. Riley Wealth. Art, great to have you back.
It's so good to be back. It's been too long.
It has. We're glad to have you. Stocks are pulling back from those record highs today, although those losses at this point are pretty modest. But Art, you think this is a market that will power higher. How much higher can it go?
Well, a couple things. I think first and foremost, the fundamental backdrop is very supportive of this market, right? We're in the second week of earnings, and the earnings season has been much better than anticipated, and guidance continues to move higher for the calendar year of 2026. I think the second thing is that assumptions made about the duration of the war in Iran are starting to stretch out a bit, and that's the bad news. So we're kind of in a tug of war right now during earnings season where concerns over the war had taken a bit of a back seat while we focused on the micro company by company earnings reports, but they're creeping back into our psychology, and we're starting to hear things that push out the duration of this war. The closer we get to an exit ramp, the higher this market can go, and if we find an exit ramp to this war in Iran, I think the fundamental backdrop would be able to move this S&P 500 significantly higher than we are now, talking about 7,600.
7,600 by year end. What is it that actually gets us there, though?
What gets us there is the earnings growth. So at the beginning of the year, the consensus estimate for earnings in the S&P 500 sat at about $312. It's currently at $320, and that's before we've even heard from 30% of the S&P 500 companies for the first quarter, and guidance has continued to move higher even as we've entered a war in Iran. So I think that's the biggest driver. So you can get to that 7,600 with very little or no multiple expansion. It's all on earnings growth. Now, a great deal of that obviously is coming from technology companies, communication services companies. But the good news is for the first year and three, all 11 sectors in the S&P 500 are going to show year-over-year earnings growth. So it's a very broad growth in earnings, and I think that's why we're seeing a broad application by investors into the market here.
In terms of headwinds, though, you mentioned the geopolitical side. This seems like a market that's pretty much ignoring that side of things, at least right now. We have the S&P 500 actually inching closer to the flat line right now, so very close to all-time highs. Are investors wrong to kind of be disconnected from geopolitical turmoil?
Yes and no. So the yes part is, if you go back to World War II and look forward, the market's been higher 6 to 9 months after the start of every war since then, going back to the Gulf Wars in the 90s, and just flash forward to the war with Ukraine. So the market tends to move and become a forward pricing mechanism. I think the second thing to think about, obviously, the solid fundamental backdrop we were living in before the war started. We had gasoline below $3, a yield on the 10-year below 4%. We had earnings growth of double digits for 5 quarters in a row, and expectations for this year to be another double-digit earnings grower. So those are all the positives. I think the negatives is the longer you have higher energy prices, the more deleterious that is to the global economy, the less consumer spending power we have. And so it's a function of duration, right? So if our assumption is that we find the exit ramp to this in a month, then the damage done to the economy will be far less than if this is something we're still talking about in the fall.
What's the first sign that the path to 7,600 is breaking?
First sign would be if you start to get degradation in earnings estimates, and we haven't seen that yet. Now, there are companies that are beating but not raising their guidance because of uncertainty over the war, and that's okay. But if you start to hear from companies, especially companies that are very dependent on energy, right? Think logistics, travel and leisure, materials, industrials, and they start to cut their guidance for the balance of this year because of what we've already seen in higher energy prices, then we'd have to reconfigure that number and probably take that estimate for $320 down on the S&P 500 and use a different multiple. But right now we haven't seen any of that degradation in earnings estimates.
So every dip has been a buy recently. It seems to be the case. Do you think that's still the playbook here, or are we getting late in that trade? And what is the strategy from this point on?
Yeah, while dip buyers have certainly been prevalent in this market, I would also say that the rotation has been massive as well. So just think about how much technology was for sale starting last October, and artificial intelligence was going to disrupt everything, and we're clearly going to see companies being destroyed by AI. We're certainly going to start to question CapEx and return on invested capital. And all of a sudden, the first dip that was bought in this market was technology, the most oversold of the S&P 500 sectors. So I think that's important. But along the way, there's been a real intuitive reaction to this dip buying where it's spreading out to those sectors that are less energy intensive, and we're starting to see a bounce in things like healthcare and financials. Again, two underperforming sectors. So there's some symmetry to this dip buying, and it's not just all in on AI in any given day, and it's a much broader approach. Yesterday was a perfect example of that. We hit 7 of the 11 S&P 500 sectors in the green, and that's been a pretty clear pattern through this resurgence in markets to get us back to where we were before the war started.
In a market like this, where do you need to be overweight right now to actually outperform?
Yeah, I think technology is still the best of the bets. If you look at the multiples that the technology sector are throwing off, it's 5 multiple turns below its historic average. It got down to 7 multiple turns at the beginning of the year when everything was for sale in technology. So obviously you need to have a weighting in technology. But I think the sectors that can really outperform as we start to exit this war in Iran are financials. Financials should certainly be doing much better than they are. They're beneficiaries of active capital markets activity, M&A activity. The IPO calendar looks robust, less regulation, and the yield curve likely is going to be helping their net interest income. And the third that I would throw in here that doesn't get much talk is healthcare. We've already started to see a lot of M&A activity by big pharma into biotech, and I think that's just the tip of the iceberg there. So all 3 of those sectors should be equally owned, I think, and two of the sectors that away from technology that I think really have a lot of runway in front of them are both financials and healthcare.
But to your point, we have seen this massive rebound in tech just recently. Is it too late to add that exposure to your portfolio if you're not already in?
Yeah, it depends on which side of that you're looking at. And we used to sort of break this down in simple terms, software and hardware, and where hardware has run the most, and that's been going on since the fourth quarter of last year. And a lot of that has to do with memory and semiconductors, semi-cap equipment companies, et cetera, just because of the massive demand for memory at the data center for large language model developers. Software is still not recovered back to the beginning of the year levels and still trading at a multiple. So we've seen a bit of a bounce, but think about it like this. The IGV, which is the software ETF, was from peak to trough was down 45%. Now it's bounced about 20%, but still sits at a multiple that we haven't seen in years. So companies like Microsoft, for example, trading at a 24 multiple, which is 4 multiple turns below its 5-year average, because it's going to be disrupted by you and I vibe coding and replacing what we use Windows for. I just think it's very overdone. So to me, I think there's ample opportunity in technology, but right now I think the opportunity is better in software than it is in hardware.
Can you be more specific about where in software? You mentioned Microsoft,
yeah, I
obviously,
certainly would.
but any
yeah,
names?
Microsoft's a great example of that. It's one of the largest of the software companies. But along the way, I think at the application level, you have to ask yourself a question. Are there software applications that are too embedded in the enterprise and in the consumer's personal life to be disrupted and displaced by artificial intelligence? So the tip of the iceberg there, I would certainly say, would be Microsoft. But further along the way, when you sort of look at the companies like Salesforce that have been using artificial intelligence for the last 5 years, just didn't talk about it and how embedded that is into the processes, especially at the enterprise level, and certainly hard to replace. And think about it like that. Now, there's certainly other software companies that are easy to replace and likely won't make it. I think of things like the ability to do your taxes online is likely going to get a whole lot easier. So if you're a software company that's your only game, you're likely going to be disrupted. So things of that nature. But to me, I think it's the large embedded enterprise level software companies that will likely survive this and still look very attractive.
So Salesforce is down 8% today. You'd be a buyer here?
Yeah, Salesforce gets beat up every single day. They've stopped making massive acquisitions. They're focusing on what they're good at, and the multiple it's trading at right now really feels as though it's going away because someone's going to replace it with something that artificial intelligence can do instead, and it just feels as though that's such a huge overreaction. And I would argue that large embedded enterprise level software companies are only going to get better and more productive and more helpful to companies, and likely will be better coming out of the end of this. But right now we're in that SaaS apocalypse where everything software related has been for sale, and I certainly think that story is well overplayed.
Okay, and just finally, what are you avoiding right here? You mentioned that you like financials, healthcare, tech. What are you staying away from?
A couple things you have to be careful of, I think, in the near term. First and foremost, I think one is the safe harbor sectors, like the consumer staples, which obviously made a great deal of sense when there's a lot of uncertainty over a war, but they got bid up to a multiple level on average that was about 10 multiple turns higher than where they normally trade. So if you look at the staples as a sector, they were trading at about 24 times next 12 months earnings. They usually trade about 15 or 16 times. So somewhere in the middle of that probably is reasonable, but they're still north of 20 times. I'd just be careful with those safe harbor assets when things get better. And we saw that for a couple of those days where the NASDAQ is up a couple percentage points, and the only thing down is things like energy and consumer staples, and to a certain extent, the dollar and gold. Now, another thing to think about that I wouldn't throw the baby out with the bathwater on is energy. Obviously, the sector's had a very good year, but it's having a very good year in an environment where it never reflected the high point of the increase in the price of a barrel of oil. And getting back to pre-war levels of energy prices is probably going to take at least a year, if not more. So in between there, I think all of the energy companies, especially the fully integrated nationals like Exxon and Chevron, are going to have a very profitable year. So I think energy will likely sell off from its peak, but be a great buying opportunity on any dips. And I think that's one of the things you want to think about, especially companies like Halliburton that have to participate in the rebuild of all of the infrastructure and oil production infrastructure that's been destroyed during the war. So I just think I wouldn't throw energy out, even though it's been the leader during the war. Let it pull back a bit, and I think there's going to be an opportunity there. The last thing I would offer up is, broadly speaking, I would rather be in consumer discretionary now than in consumer staples, and for the reasons I stated before. Away from that, I think that there's a plethora of opportunities. One of the biggest concerns I have also is that when you sort of say, oh, you shouldn't be in tech, you shouldn't be in communication services, because people just think about the Mag 7. There's probably 25 or 30 artificial intelligence related names that don't fall into that category. They're creeping higher. Mm-hmm. So I think there's great opportunity there as well.
What's the number one name on that list that's not Mag 7?
I would have to say Broadcom. In real terms, it's obviously not a secret to anybody, but we talk about Mag 7 like it's a monolith, which it's not. And Broadcom is doing a lot of things, getting a lot of contracts. They are a must-have in an AI data center build-out, and clearly that's been reflective in some of the gains that we've seen in it recently. But I still think there's a lot of opportunity there, and it just doesn't. There's no way to get a good acronym and try to slip a B into it, so it just hasn't fallen into the easy artificial intelligence darlings bucket.
But it's up 120% over the past 1 year, so still. You can still
coming
add
off a
it
real
here,
low base,
or do you have to wait?
Yeah.
Okay.
It's interesting. So, like, if we went to a speed round and you said which would you rather, and it was Broadcom or Nvidia, in the here and now, I would say Nvidia, because it's trading at a 24 times multiple, and has gross margins north of 70% and grew its earnings probably 50 or 60% in this quarter. They're going to report at the end of the month. So, but I think Broadcom, you just even though it's up 120%. You have to think about the fact that in the longer trajectory of the artificial intelligence revolution, they're going to be a key component in everything everybody does.
Okay, you mentioned a speed rally. It's a perfect time to pivot to our rapid fire game of this or that. You know this game. Quick questions, quick answers. Are you ready, Art?
You bet.
Here we go. S&P above 7,100. More room to run or getting stretched?
More room to run. I think there's ample opportunity for us to continue higher.
Buy the breakout or wait for consolidation?
I think you can buy the breakout. People get nervous about buying at all-time highs. Unfortunately, if you did that, you wouldn't make much money over the last 20 years.
Cash, deploy it or hold it?
I think it's time to deploy it if you have a large cash balance and you've been waiting for the dust to settle. Remember, the dust never settles.
Add risk or play it safe?
I think you can add risk here. Playing it safe is likely going to be sold off. I think the safe harbors are going to be sold, and I think riskier assets are going to be bought.
Tech, leadership or liability?
Leadership, and it's always going to be leadership. It had been for sale since last October. It's now catching a bid. Wait till you start hearing some of the reports next week.
Remember, quick answers, although you do speak quickly, so I guess you check that mark. Art, earnings, headwind or tailwind?
Significant tailwind, and guidance having already gone up Usually goes down by 2% before this earnings reporting season started. It's gone higher.
Better buy after earnings, ServiceNow or IBM?
Oh, such a great question. I'm going to have to go with IBM. I think IBM's quarter was misunderstood.
Tesla or Texas Instruments?
Texas Instruments by a long shot, and it's just starting to get its mojo back and had a great report.
Southwest or American?
American, unfortunately. I love Southwest, but American's got, I think, a better longer-term platform.
Better dip to buy, Nike or Lululemon?
What a great question. Lululemon's stealing somebody from Nike right now to be the new CEO. I think they're both great dip buying opportunities. I personally would go with Lululemon before Nike.
AI infrastructure play, NVIDIA or GE Vernova?
Oh, two great companies. And GE Vernova is trading at a multiple that is actually so much higher than NVIDIA, you have to go with NVIDIA.
Biggest market driver from here, earnings, Fed, or oil?
Earnings, I'd like to say oil, but I don't think it's going to be for much longer, so earnings it has to be.
One stock you'd buy today?
One stock I'd buy today, I would have to say, right off the top of my head, that TJX, and I'll tell you why. It's the perfect stock for the environment we're in right now with a choiceful consumer.
One stock you'd avoid today?
Such a great question. I'd avoid Tesla. I don't know what they're going to do with this IPO and if they're going to combine, and there's a lot of noise around that. So Tesla is one that you might want to take a backseat on.
One word to describe the current market?
Cautiously optimistic. That's hyphenated, so that's one word.
And finally, your S&P 500 price target by year end?
7,600, and I think that's a easily achieved conservative target if, in fact, we get out of this war before July 4th.
Art Hogan, Chief Market Strategist, B. Riley Wealth. Always a pleasure. Thanks so much.
Thank you so much for having me.
If you enjoyed this interview with Art, check out our full street talk with George C. He explains why this could be a sell in May year.